We all know that investment is a trade-off between risk and return. So what kind of investment returns should we expect over the very long term if we invest in equities or if we invest in bonds? Let's look at that in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. In a 2017 survey, Schroders found that people expect 10% return on their investments every year over the next 5 years. And the millennials born between 82 and 99 expected almost 12% a year until 2022. Now, how realistic are those expectations? It's always good to calibrate our expectations of the future by looking at the long-term past. Now, fortunately, the S&P 500, which is the US stock market, has a lot of history. And when we look over a long period of time, we always have to adjust using the rate of inflation. By subtracting that, we get the real return, which tells us how much the buying power of our money has increased over time. And because shares give us dividends, we'll reinvest those back into the index to give a total return. And thanks to Robert Shiller, we have 150 years of data, and you can see the real return over that period was almost 7%. Just to see the power of dividend reinvestment, the blue line shows what you'd get if you reinvested your dividends, and the red line is just what you get from capital appreciation. You buy low and sell high. You can see the compounding effect of the dividends is unbelievably powerful, boosting the real return from 2.3% up to 6.8% on average over the last 148 years. So the key question is whether the future will resemble this quite rosy past. One of the reasons why that might not be the case is that global population isn't growing as quickly as it did. This is global population growth since 1950, and while it was bobbing at around 2% up till 1980, since 1990 there's been a fairly sharp fall, and now we're looking at rates of around 1%. For companies, that's bad news because their earnings growth depends on selling more stuff, and if there are less people to whom they can sell stuff, it's going to curtail their earnings growth. Another problem is that the world is aging, and the dark blue colours show the countries where the median age, that's the typical age, is older. And unfortunately, those are also the countries which have most money. The asset management company Vanguard has produced a 10-year outlook, and they point out that we've just had two incredibly strong bull markets. And it's not a coincidence that interest rates have been falling during those two very strong equity rallies. What they mean by a secular fall in interest rates is a very long-term trend. You can see that between the 1960s and the 80s, interest rates were steadily rising in the United States. But after this period of high inflation, interest rates have been steadily falling for decades, and they probably bottomed out at around 2015, and now they've started to rise again. The reason why that matters is that US Treasuries are super safe. They offer an almost guaranteed income, and when that guaranteed income is low, it pushes us into riskier assets, like shares, and pushes up stock market prices. To see why, imagine I give you a choice between two things. Either I'll guarantee you an income of 1%, or I'll toss a coin, and either you'll make 10% or lose 10%, depending on whether it's head or tails. But if the guaranteed income is higher, say 5%, then gambling might not be quite so attractive. And in this analogy, the safe income is government bonds, and the stock market is the gamble. And at a certain point, as government bond yields rise, equities simply become much less attractive. Why take the risk if you can earn a guaranteed income by lending to the government? In their report, Vanguard actually produces a forecast with built-in uncertainty of what the returns will be for various markets. Now, with any prediction of the future, it's probabilistic. The uncertainty of the forecast is represented by a box plot, and the key to the box plot is here on the right. And this is a 90% confidence region, which is fairly broad. It ranges between -4% and about 12% for global ex-UK equities. But the most likely forecast is around 4%. If we include the UK, the most likely forecast is a little bit higher. And for UK equities, because they've sold off so much, their valuations are more reasonable, so the most likely forecast is just under 5%. For the fixed income market, which is bonds, the returns are much lower. Almost all of the fixed income products have a most likely forecast which is less than 2% return. The only exception is UK credit, where you're lending money to UK companies. If we look at this risk-return plot, and we look to see how a 60% equity portfolio would have fared since 1970, it's moved from a very high return, high risk investment to a lower return and lower risk investment since 1990, and in the coming decade, Vanguard expects much lower returns. In fact, it's about a third of the returns that we've seen since 1970. And whatever tilt you give to your portfolio, moving more into credit or inflation-linked bonds or emerging markets, isn't going to help. All of them have a return of around 4% or less, according to Vanguard's forecast. The reasons given by Vanguard are elevated valuations, in other words, too much irrational exuberance pushing up prices, and low interest rates. And they also show a variety of portfolios to see how they'll fare according to their forecast returns. And you can see that the median forecast, that's a typical forecast return, is never more than about 4%. So if markets are going to have low returns, then what can we do? All that we can do is to save more money and invest more money in order to boost our returns. And the three ways you can do that are to earn more, spend less, and work longer. So don't plan on an early retirement. And if returns are just 4%, then a 1% fee would be a quarter of your returns. And that means that we have to be even more vigilant about the fees that we pay. 4%. That sounds very pessimistic, doesn't it? But of course, there are good reasons why returns in the coming decade may not be as good as the ones in the previous decade. And we'll have to contend with 2% inflation. But the key thing is to keep an eye on fees, because they'll gobble up an increasing amount of those reduced returns. I hope you found that video useful. If you did, please consider supporting us on Patreon. It's really easy. Just click on the button above. And if you pay $15 a month or more, you get to join me in a power hour every month. And that would be like Kishore Bhagwat, Craig Zeitel, and Andrew McMillan, who are already supporting us at that level. And as always, thank you for listening.